In today's video, you are going to know every single thing you need to know about supply and demand trading. When I mean everything, I mean everything from entry to stop loss. And the good thing is, this is exactly how I trade. So I'm going to pretty much spill in all the beans to you guys. So you know all the confluences that you need to know. There are precisely about 4 different confluences. I'm going to go through every single one in detail. So you know exactly what to look for. You know what setups are high probability, what setups are low probability. So without wasting too much time, let us get straight into it. Get your pen and paper ready and start taking some notes. So first thing first, what is supply and demand in the first place? Supply and demand is very, very simple. I like to describe it as when you have aggressive buys and aggressive sells. But before even going to what it looks like on the chart, understand it in terms of just a normal basis. Supply and demand is just when you have too much of something, that's when you have a lot of supply for it, and demand is just when a lot of people want something. And I like to use an example, which is like, for example, this iPhone right here. Because I have a lot of it and let's say not too many demand for it, this means the price will continue to go down. I have to reduce the price, so I can actually get all of the iPhones off my hand if I had like 500, for example. But if I had just one iPhone and I had 50 people wanting to buy this iPhone, I can literally decide I want to sell it for 100, but then when there's like more offers, I can decide to go to 200, 500 pounds, 2,000 pounds, because there are a lot of demand for it. So generally when there is demand, price goes up. That's what you should think of it as. And when there is supply, price is going down. That's just a way to look at it from a general perspective. But now let's look at this on the chart. On the chart now, we also have supply and demand. This is on the 1 hour chart, for example, because it's very, very easy to see. Demand is simply when price is going up. So for example, we can say that this is a demand zone. But before I get to the zones, why is this a demand? You can see price forming consecutive blue candles, multiple blue candles, 1, 2, 3, 4, 5, and it kept going up. That is a demand. That's when you know there's aggressive buys and buys and buys and buys over and over and over again. So it meant that at this price right here, just when this black candle formed at that price, buyers loved that price, so they just kept buying over and over and over again. And then after that, you will see that we then have a supply. What is a supply? Supply is the opposite, right? So this is a supply right here. You can see we had 2 aggressive black candles. Then eventually price kept going down and down, multiple black candles, and it's even still going down up till now. So that is known as a supply. So what you need to look for, we will get into shortly, but just understand that when you see multiple blue candles, you have demand. I'll show you a few more. So we can see, for example, we have blue candles right here, you know, even from this. So let's say, for example, we have blue candle, blue candle, blue candle, black, blue, blue, black. This is still a demand, right? It's still price pushing up aggressively in one direction like this. So it is still a demand technically, but I will show you guys precisely the ones you need to look for and the ones you need to stay away from. Now, before you even get onto supply and demand, what I need you to first understand is trends. Just understand market direction, because this is the basis and the foundation of everything that you are going to do. So the best way to just understand trends is looking at it as like stairs. Right now, we can all see clearly that this is pushing upwards. There's no debate in it. You know, we can see generally price is going upwards, and now we can see that now price is sort of going downwards. That's very, very clear to see. So you kind of need to get familiar with direction of the market. And we can see that if we're looking at this whole section here, it's generally going sideways, right? It's not really going upwards or downwards. Price is just going sideways. And this is from November all the way to December. So sometimes price can be really rubbish like this for, you know, 2 weeks straight like this. So that's price going sideways. And then we can see right here that this is aggressive, you know, or downtrend, aggressive. So this is price going downwards. And then you can see before that price was going upwards aggressively as well. So generally price is going to be going either sideways, upwards, or downwards. Those are the main 3, and the ones you want to be trading in is when price is going either upwards or downwards. Those are the main 2 that you want to trade in. Sideways, generally avoid it, right? You want to generally avoid it. It's not going to be the best conditions. Your TP isn't going to hit all the time. Your stop loss will get hit often. You get pump faked often. So you just want to usually avoid those market situations because it's just not favorable. So trends isn't a confluence, but it's something that's very, very important. Now this is on the 1 hour. I trade on the 3 minute. So you can technically do this on the 5 minute, 3 minute, and the 1 minute as well. Those are the 3 that I would say I've worked with that I feel like you can use. So whatever I tell you or go through today, you can apply this to any of those time frames. But my main bread and butter, I would say, is 3 minute. But I also use the 1 minute as well. I want you guys to identify the same trends, basically on the smaller time frame. What this means is that usually smaller time frames are a lot more noisy. So it's harder to read, but it's still the same idea. We can see generally today so far, price has been going downwards. So that's been the idea. And this is on gold, right? Price has been going downwards in that situation. And we can see price has been going sideways. in this case, nice and easy, and we can see price is also going downwards in this case. These are very simple stuff. Just looking at it, you know, when you zoom out a little bit and you look at it from you know, a wide perspective, that's what you can see. So that brings me to the next and the first confluence, which is market structure. Extremely important. Market structure now is how you identify the market direction, but in a smaller time frame. How do you actually know that price is going upwards? How do you know price is going downwards? Because it's easy to see, right, that price is going sideways like this. But if I was to go back in time and start from here, you don't know price was going to go sideways, right? You still think price is going to keep going downwards. So how do you know what price is going to do, or actually read between the lines? That's what we're going to go through now. So when it comes to market structure, we have higher highs and we have lower lows. It's basically telling you the direction or what price is doing. So for example, in this case, we can see that price went up, went all the way down, went up slightly, you know, decided to go all the way down like this. In short, just reading that, price formed a high right here and has formed a lower low, formed a small high again, and then formed another lower low, meaning that this high is higher than this high, and then this low, well, this low is lower than this low, so is this low is lower than this low. So what this just shows you is that price is going downwards. When price goes downwards, we keep having lower lows and the highs are lower highs, if that makes sense. So you're having lower lows, lower lows, lower lows, and the highs are also getting lower. So everything's just going downwards. That's how you read these, you know, between the lines. So now that you see this, your general idea would be price is also going to form another small high and then will form another lower low. That would generally be the idea. So it makes sense. If you're seeing this price action, it actually does make sense to take a sell, to only be looking for sells. You shouldn't really be looking for buys when you see price doing this. It doesn't make sense. So this is how you come to an idea of, people call it bias. I don't really use that term, but when you read the market, read price action, now you should just be taking sells, nothing else really, until price gives you another change of character and all that stuff, which is basically just when price decides, instead of forming a lower low, it decides to form a higher high. So in this case, let's say price decides to just shoot all the way up here. Price has now gone above this high. So now that's a change of character. So now we can start expecting, okay, maybe price wants to start going in the upper direction. Now, another example we can see in this case, let's start from here. So price did all of this, went low. It didn't really break this low, right? It hasn't broken this low, but then it went all the way up. In this case, now we formed a high. This high is greater than this swing high right here. And then price goes down, forms a low, but then the high is greater than this high. And you can see it to continue to do the same thing. So now you can see once again, small low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. You get the idea, right? It's forming, it's like stairs. That's how I like to look at it. You know, we're going up the stairs, the high, it keeps getting higher and higher, nice and simple. The low is just getting higher and higher. So overall, you're taking buys. You don't care about anything else but buys. This is extremely important because this is going to determine if you're even looking for a supply in the first place or a demand. That's going to be, so market structure is going to be the foundation to know what you're doing in the first place, to know if you're looking for supply or demand. Because if you take the wrong one, you're just increasing the probability of you losing, right? And then you can see eventually price now forms a lower high. This high right here is no longer breaking this high. So this tells you, okay, maybe price is not, you know, going higher anymore. See why it's super important? Because then you can actually see how price isn't really moving anymore, right? Eventually it does go all the way up, breaks this high, but after that, that was it. Now that's the point where price sometimes catch people out, but sometimes these aren't really, let's just say it's the expense for trading, right? Because yes, there'll always be pump fakes. Price will go high like this. You think you should keep taking buys. You might take a buy and then price dumps all the way. But that's just part of the game. Sometimes you'll get it wrong. Sometimes you get it right. Because eventually price does dump and then starts going high again. But overall, the reason why things like this happen, if you think about it, this is at 1 a.m. This is at midnight anyway. You shouldn't be trading at midnight at all, because at midnight, things generally don't behave properly. It's a bit weird at midnight. Some people do trade Asia session. That's not really my forte, but generally you don't want to trade at midnight. Volume isn't as good, things don't behave properly, etc. I mostly just trade London session, or I'll trade New York session, mostly London, but if I couldn't trade London for some reason, I'll trade New York, and that's would be it. Like, I wouldn't really trade anything else. Okay, so I've touched briefly on market structure. I should have other videos on this, but that's briefly market structure. Don't want to go through it for too long because this video will just be extremely long. So now confluence number 2, which is actually supply and demand now. So I'm going to show you guys exactly how to identify these supply and demands. And the best way to do that is to just show you a few trades that I've actually taken myself. I usually keep all my trades on the charts. You can see there's one here, there's one here, but we're going to go through some examples. So first thing first, to identify a demand, remember the first thing, market structure. So I know that price is going upwards, boom. So that means I'm looking for demands alone, and demands, remember, is price going up. So I'm looking for demands. In this case, what can I see? I can see that price forms a blue candle, a black, another blue, another blue, another blue, and a black. That's what I've seen. But overall, it's pushed up aggressively, which kind of validates what I'm looking for. That's what I'm saying. Sometimes you might not have consecutive blues, but if you do have like a blue, black, multiple blues, still valid. The key thing for me is that I want to see at least 2 blue candles breaking the previous candle in this case. So one aggressive blue like this, the black one is fine, but then I need another blue candle though to break, you know, the high of the previous one. So I can clearly see that. So this validates, okay, cool, we have a demand right here. It's valid for me. So once I have my demand, how do you draw your demand? You draw your demand from the previous colored candle. So as a demand, for example, right here, the previous colored candle, which is the black candle, before the aggressive move happens. So we have a black candle right here. That was the first, you know, that was the first opposite price movement before the blue candles. So we had the black, then blue, 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 then we had the actual, you know, movement that we're looking for. That zone, so from the top of the wick all the way to the bottom of whatever's in front of it. So in this case, the black candle seems to be the lowest, so we just draw it that way. If this blue wick was all the way down here, then this zone would also go all the way down there. But in this case, it doesn't. So this is now our demand zone. So what are we looking for? We're waiting for price to come back into this zone to then take a buy. That's all we're looking for. We don't know when it's going to happen or if it's going to happen, but that's what we're looking for. So in this case, we can see that eventually after, you know, some time, price taps into the zone, and then we take our entry, etc., which I'll go through shortly. But that is what we're looking for in this case, because when price does tap in, eventually price goes back up. Now, the idea to supply and demand is basically that price has done something before. So we have an idea that, okay, they're going to do it again. So for example, in this case, price shot up aggressively at this area right here. So we just believe, okay, cool. If they did that before, because remember, it takes a lot of money to move the market. So price, you know, a lot of buys happen for this to go up aggressively like this. So we just wanted them to come back in, and just based on data, right, the fact that it happened before, etc., we just think it's going to go back up again. We don't know how much by or when or whatever the case is, but we just know that, okay, there's a chance it's going to go back up again like it did before. That is basically our thesis most of the time with supply and demand, right? Just like sell examples, if it's sold before at one point, we feel like it's going to sell again. So we just kind of trade at that area to expect the same thing. So in this case, price pushed up, came back, pushed up again. That's all. And then we make our money depending on what, you know, price is saying. I left at this point at 1 to 1. You know, you could see I could have left at 1 to 5. You don't know that's going to go that far up, but I left at 1 to 1 for a reason. In this case, I'll just touch on it. We have a supply zone right here. Because of the supply zone, that was why I left here, because sometimes price will react to the supply zone and then keep going downwards. Remember, we don't know exactly what price is going to do. So I just played it safe. I just left on my quick 1 to 1, call it a day, GG's, and made my money. 1 to 1 is perfectly fine as well. That's one example. Now I'm going to show you guys the opposite, a supply. So in this example, we have a supply. Now we have multiple black candles right here, a blue, then another black that kind of breaks everything as well. So we have a supply. This is a low probability supply zone, and I'll show you why in a minute. It depends on the next confluence that we go through. But in this case, again, the same thing. I want price to go all the way back up. Price does go back up. Once it goes back up, I'm looking for my confluence to take a short. We do get the confluence, and eventually I took it all the way down and I left at that point. You see how in this case, I didn't go for 1 to 5R, because again, you have to read price and do what price is kind of telling you. This is a safe point, and then left here, and eventually price goes all the way up, and that was GG's. Why is this a low probability supply? I'm going to explain it now, but you guys might need to come back to this point, because this has to do with confluence number 3. The next one I'm going to go through. The reason why is because there's something known as fair value gap, which is what I'm going to go through shortly. I need my fair value gap to be very close to the zone. So it needs to be pretty much right here of some sort. In this example, it isn't. The fair value gap is right here. And in short, what that simply means is that where price, the wicks has not interacted, they haven't touched each other. So for that reason, this is low probability, and I want it to be very, very close to the zone, but it wasn't. But you can see this still won, right? It's still won. That's why it's low probability though. It doesn't mean it's not going to win. Sometimes, in fact, low probability would win, high probability it wouldn't win. It's just how trading is. But overall, this is still a supply. I'm going to go through one more example. Okay, so this example right here is on the 1 minute. On the 1 minute, you see many more setups. In fact, we have a supply zone right here. We also have another supply zone right here, and we have another supply zone right here. So we have multiple. You see this on the 1 minute, multiple. So sometimes you do have to decide which one you're going to take, but in this case I took this one right here. Why is this a supply? Simply because, again, we have 2 black candles. I want to see a minimum of 2, minimum at least. We have 2 black candles in this case, so that validates it for me, plus the other confluence that I'm going to talk about. But either way, price taps into the zone, and I entered right here, stops right here, and eventually for this trade looking for a 1 to 2, and boom, done. So that's pretty much the idea with this. It's still the same idea. We see an aggressive move in one direction, wait for price to get back up there again, look for entry, take it, and then the rest is pretty much history. So these are just a few examples of supply and demand. If you need to know more, just watch my other videos. I have a ton more examples of these, and I have live videos of me taking these as well. On to the next confluence, which is fair value gaps. This is going to be essential because this is what's really going to determine if your setup is high probability, extremely high probability, or if it's low probability. It all kind of ties down to fair value gaps. This section here can be extremely long because most people struggle to understand this the most. If you do need more, explanation, I've made an entire video on just fair value gaps. You can check down the channel and just type in fair value gaps or something and it will come up. So using the same example that we just looked at, what a fair value gap is when you have a point where the wicks don't interact. Fair value gaps, I like to say, move the market to some extent. It's part of the whole market movement. The simplest way to explain fair value gaps, again, let's go to the trusty iPhone. If I was selling this phone for $100 and I was trying to put it on a bid for people to give in their offer, I need to go from 100, let's say 105, 110, 115, 120, anyone to 430, etc. I'm going up in 5 increments. If suddenly I went from 110 to 150, I have missed out on 140, 30, 20, etc. So at some point in time, I will need to come back to offer those prices, right? That's the simple idea to it. That is what simple way to visualize fair value gaps. Every price has to be offered. In fact, realistically, it's 101, 102, 103, 104. Every single price has to be offered, and there has to be some sort of interaction between buyers and sellers at every price. Looking at it on the chart now, this translates in the same way. When we had this huge push right here, the wicks symbolizes these interactions. So the wicks needs to interact in one way or another. So in this case, we have this right here. We have a black candle, we have another black candle. Right now, as of right now, we have a gap right here. The reason why is because the wick from this candle needed to have interacted with the wick on the blue candle. So fair value gaps can be identified with 3 candles. 3 candles being the what you need. The middle one is going to be the suspect or the corporate, whatever you want to see it as. And then the other 2 are like the ones that deal with the interactions. So in this case, we have candle number 1, candle 2, candle 3. We need the blue candle and the black candle to interact in one way or another. If they don't, price is going to have to come back there at some point, and something is going to need to have filled or touch this blue candle in one way or another. So we can see in this case now, we had this blue candle has now shortened the gap. So let's check that again. Let's look at that again slowly. Right now we have a gap right here. The reason why is because there is no wick in front of here and there is no wick right behind, directly behind. So right now there's just this space. There's just this space right now at the moment. So what we need is, you can see this next candle has now shortened, has reduced the gap now, because now we are having, some kind of wick or candle basically in front of it. But still, there is still this gap right here that needs to be filled. So eventually the next candle does it maybe. Yes. So you can see the next candle went all the way up, filled it, and does not even close within it. That's when you know you have a good setup, by the way. When they don't close within it, it just shoots up, fills it, and immediately starts going back its way. So it almost went back, offered those prices, and then continued in the direction that it was going in anyway. So once we got that, you can then see that the rest was history. The price just kept melting afterwards. But now you can see how there's another fair value gap that is formed. Fair value gaps always get formed, but they will eventually need to be filled at some point. And what that simply means is that there will need to be some kind of candlestick in front of it at some point down the line. We don't know when, but there will be. For example, we can see we have more. We have fair value gaps literally from here all the way to here. Again, think about the same reason. We had this huge black candle, then we had this candle next. So the black candle being the suspect, the wick only goes up to here, the wick of this blue one only goes up to here. So there will need to be some kind of candle that needs to go in front of here to fill this gap at some point, basically. You can see how it's not happened yet, but it will need to happen at some point down the line. Now, looking at one more example, we can see in this case, from when we had this dump right here, we have multiple gaps, multiple gaps. In fact, we technically have a gap all the way like this. We have a gap right here, for example. Boom, 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 boom. You can see right here, there's nothing to the left, nothing to the right, empty, clear space. So we need this wick to interact with the ones to the left. So eventually price does fill that gap. And now we can say the gap is completely filled totally. But you can see as price continues to form, new fair value gaps just continue to form over and over. That's how you know when there is an aggressive move. Because when it's aggressive, it just goes from one price straight to the next. So now you can see this clearly. Look at this. The previous wick is here. The next wick is all the way up here. So right now there is this space right here where there is just no, price hasn't filled this gap yet. So price will need to come down, fill this gap somehow at some point for it to be filled. And this happens over and over again, especially on the 1 minute. You're going to see a ton of it. We don't know when. In this case, oh, okay, you can see immediately price has now come all the way in, fill the gap. So now when the gap is filled, it just means that there is some kind of candlesticks in front of it. So there is no gap. There's no gap here. Why is there no gap here? Because there's a wick completely to the left of this. So that's mean it's filled. And there either needs to be a wick completely to the left, or it will need to happen to the right of it. In this case, you can see to the left of this, let's say this black candle is a suspect. To the left of it, we have a wick all the way up till here. And to the right of it, there's nothing. If this was all the way to the left, all the way down here, then it would have been filled. But right now we have this space right here where there is still nothing. So at some point, price will need to come back here to fill the gap. I'm showing you guys as many examples as possible because this is the hardest one to comprehend. You might need to watch this part a few times to understand it, but those are fair value gaps. Fair value gaps is just when it's formed, when price moves in aggressively in one particular direction. And what fair value gaps shows us, why this is so important, is that when you add this on top of the supply and demand, it adds us two major magnets in a way, because the fair value gap shows us that, okay, price is going to come back here at some point to fill this gap. Plus, when you now merge this with a supply or demand where price aggressively did something, so in other words, you're using the fair value gap as bait, right? It's the bait. Okay, come and fill the gap. Once it fills the gap now, it hits the demand zone, and then boom, starts shooting back in the same direction that it came from. That's the idea to it. It's kind of like, I thought, how would that make sense, right? That's basically the idea. It's kind of like bait, taps, and that's why I want it to be very, very close to my supply and demand. So as soon as it hits, we get an instant reaction. It doesn't even close in, and boom, we can pretty much grab, quickly scalp X amount, and then we leave and call it a day. We're getting somewhere, nearly there. Now the next confluence is how we actually enter the trade in the first place. So far we know how to find it, etc. How do we enter the trade in the first place? So I'm going to find another random example so you guys get a fresh perspective. So I'm going to show you guys a trade that I took today. Exactly how the entry was, everything. I'll explain the whole thing to you so you get the entry. Once again, you guys should now know at this point that this is a supply zone because we have multiple black candles, multiple. This was the initial blue candle before the dump starts to happen. So we have that set up right here. Boom. So eventually price goes all the way up, eventually taps into the zone, and now we're looking for sales. Basically nice and simple. Prices taps into the zone. You can see as soon as they filled, now this is key. In fact, let me touch on this once again. You can see this as soon as the fair value gap was filled. There are no gaps all the way up here, but there is a gap up till right here. This is where the gap is. You can literally see to the T how price reacts to fair value gaps. It literally went all the way up, taps that fair value gap, filled it, and immediately just started going the other way. You can see how like important fair value gaps are because it filled it perfectly and started melting. But I wanted to find my entry because sometimes they will fill it and then keep going in that direction. It doesn't happen all the time. But in this case, I waited for my entry, and my entry is very simple. I just need a candle to go past the previous one. That's it. So you can see that once price tapped the zone, I did not enter here. I needed the next candle to simply go past right here, to just go past this previous candle. That's it. So that just shows me, because when price is going past another candle, it shows you that it wants to continue in that direction. If it doesn't, it just, they're not trying to go past, they're not trying to fill that order, they're not trying to go in that direction. Sometimes you will get pump fakes, meaning that price might go down and then just continue back up. But overall, you want that confluence. It's very important. So you can see that when I was looking at this in real time like this, my stop loss was right here. I wanted price to go past this candle right here, and eventually I was just looking to leave right here. Where did I leave at? So I left pretty much right here. Boom, 1-on-1, nice and easy. And in this case, you can see, okay, the next candle did not go past it. That's very important. It's good I'm showing you guys this now. It didn't go past it. So now I'm looking for my next candle to go past it, right? I just keep on moving it until a candle goes past the previous candle. That's it. That's all my confirmation for entry is. So the next one does. So now that I'm in this trade, my stop loss in this case, in terms of stop losses, there are multiple ways you can see it as stop loss. Above the candle, like this. So the candle went all the way up. So you can just set it right above that because this was the highest point price got to within the zone, or the middle of the zone. Sometimes you will see in my videos, I have my stop loss at the middle. This just gives you a bit of breather, you know, a bit of breathing room. Just so if price does want to go back up again, test the zone again, you don't just get stopped out immediately. And then you can put it right outside the zone. This is the safest option, right outside the zone. That way, if price is to go all the way up here, you know, okay, cool, this trade is completely invalid. It just wasn't meant to be. But as you can see, the higher your stop loss is, it just simply means your take profit will be a lot further away. Initially, I was trying to leave here. Now, this is only a 0.53 take profit. So when it was up here, this is a 1-to-1. So you can see how it does make a difference. So if you're going to put your stop loss up here, you need to understand that you might not get your 1-to-65 RR that you're always looking for. It's just not going to happen. So sometimes you need to move it closer so you can quickly scalp and make that money and then leave, because yeah, it just takes way longer the further your stop loss is. But in this case, my trusty stop loss was right there and my trusty take profit was right here. Price played around for a little bit. In fact, let's go back. Let me show you guys exactly, you know, again, how all of this goes. Why like when I'm trading, I'm so confident because I'm able to read what's happening. Of course, not everyone knows what's going to happen, but I'm able to read or at least have an idea. I'm not just clueless. Once we had that first initial push, what do we have? We have another supply right here. It's not broken any structure. It's not formed a lower low or high or anything, but we do have a supply. We have aggressive move. Why? Because we also have a fair value gap from here to here. So we have a fair value gap present. So what am I thinking? I'm thinking at some point now, price might want to go back up to fill this as well as tap into this and then continue. That's why I was so confident in this trade. And this was a trade I sent out to the academy lots. I believe some people might have left and panicked when they were in this trade. But for me, I knew that, okay, cool. Price is going to go back up there. Now I'm thinking in real time, this should now continue downwards, right? But they didn't want to yet. So guess what? Price is still playing around. But what did I like? I like the fact that price has not closed within the box, within that zone. It's still respecting that fair value gap. You can see again, they pushed all the way up, but just kept rejecting. Another candle still didn't close. It literally closed right on the line, kept rejecting. And then the next candle now starts pouring and it continues to pour. You can see how the fair value gap as well had been filled. Supply had been tapped in. So we had a supply within a supply in that case. And now what am I looking for? So you can see how my TP was right there and boom, price slapped my TP and I'm out. Nice and easy. That was it. GG's. The rest was history. Very, 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 very simple. Now this right here is what I've just shown you. This is the bread and butter. This is what I do day in and day out. These are the trades I take day in and day out. Same entry, same exits, same take profit. And we just keep rinse and repeat. So I'll show you guys another example of like a full trade so you can look at it from start to finish. This week I literally did not have a single losing day, right? I went 4 for 4 this week. Very, very nice. And we didn't have any setups on one of the days. But this is another example. This is literally the day before. Again, let's start from scratch. Boom, this is what we're looking at. We can see an aggressive move to the downside. Immediately, ding, 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 you're thinking this is a supply. Huge supply. Massive, massive supply. And this was the initial candle before the black candle started happening. So I mark up my supply from the wick to the wick. Right now, we have a fair value gap that goes all the way within the zone. So the fair value gap technically is all the way from here. And then we have it till here. And then we also have more, of course, you know, we have fair value gaps pretty much like this. So these are the gaps. We have gap here and we have a gap here. But all of that I'm not too fussed about. I don't need to draw it, but you can see it. I'm just sort of showing you guys exactly where they are. All I'm waiting for now is very, very simple. So what would I tell students? I'm just going to pretty much mark this up. So they kind of know that I'm looking for sales right here. If price does come there, I don't know if it's going to come there, but if it does, then that's what I'm looking for. Eventually price plays around, and we tap into the zone. As soon as we're in the zone like this, I'm ready. I'm looking for my shorts. I'm looking to sell. Eventually, we haven't got the break of candle yet. I'm waiting for my break of candle still. Boom. I'm waiting. My stop loss is going to be right here. I have no idea if they're going to give it to us yet, but remember, I'm just waiting for that break of candle. I want them to go past the previous candle. And for my take profit, just leaving here. Let's say I'm leaving right here. just, I think I left around here. The video is on my IG, be sure to check that out. I post pretty much my live trades pretty much daily on my Instagram at Salih's Advice. So you want to be following me on there for all the behind the scenes and all my trades and stuff on my story. So right here is where I'm leaving at, give or take. Do we get the entry here? I don't remember. Yes, we do. So now the candle has gone past the previous candle. I'm in this trade now. Everything is set. And now boom, 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 boom. Price just kept melting, kept melting, kept melting, kept melting, and we are out. And just like that, perfect exit as well, because eventually price just shoots all the way back up. That is what we do. Those are all the confluences, right? Those are all the confluences. But even before that, actually, there's one that I did miss and I didn't tell you, which is market structure, right? How do I know that I'm looking for sales in the first place? Price is going all the way down. We're forming lower lows. So you can see price does this. Price hasn't broken this high. So price does this and kept forming minor lows within that, and then does this. So overall, these are giving me sales, right? I'm not buying. So that is how we were able to apply the market structure to actually know what direction we wanted to take price in. And just like that, very, very simple. By the way, if you guys are finding any value in this video, all that I ask for is that you subscribe and do like the video so more people can get to see this and actually learn how to trade for themselves. That's all I ask for. Just make sure you like and subscribe for more videos like this. I have a ton more videos like this, a ton of live trades examples that you guys should look at as well, so you can see me implement this in real time. But finally, let's touch on exits, right? Now you guys kind of understand the entry. You might understand the exits a little bit, but for exits now, what am I looking for? So let's look at this trade I just showed you guys. In this case, this is on GBP USD. When I entered this trade, why did I know that I was leaving here? Now, exit number one that you can apply is fair value gaps, right? Nice and easy. Just kind of go into where the fair value gaps gets filled, because you know how important they are now. So as soon as the fair value gap gets filled, you know price might react in a certain way. And right now we have a fair value gap that goes all the way down here. So you could just decide to leave as soon as that gets filled. Boom. Got filled, price done, GG's, it started going up the other way. That's number one. Number two is just simply taking a one-to-one. I do respect my one-to-ones, you know, let one-to-ones be great again. A lot of people do not respect one-to-ones, but yes, you can use them, you can take them. Just take your one-to-one consistently and you'll be good. The idea to taking a lower TP like that is that you will win more consistently, because price should have hit one-to-one most of the time. If price doesn't hit one-to-one at all, I just like to say the trade wasn't gonna play out at all. You know, it wasn't meant to be. So you could just go for the one-to-ones, and most of the time I go for 1-2s as well. Why? This is just a simple formula of, if I was taking just one trade per day, 5 days, all I need to do is win a 1-2 twice, which price will sometimes get there. In fact, most of the time I find that 1-2 is that sweet spot that price gets to more often than not. So take my 1-2. If I win Monday, Tuesday, I'm up 4%. And let's just say I lose Wednesday, Thursday, Friday, I'm down 3%. So in total, I'll be left with 1%. Worst case scenario, right? That's assuming I lost 3 days in a row. So just based on that, that would mean that I will be up 1% for that week. Now, 4 weeks of this same pattern, then that means I'm up 4% in the month still. 4% in a month is still very, very good, because if you are trading with a 100k account, that is still 4k that month. That is still very good money on like the worst case scenario, right? But for example, this week I went 4 for 4, so you can see how sometimes you just win a lot more. It's a whole different ball game. So that is sometimes, I guess, a take profit that you can use, but generally once you're in the trade, I would say just follow either of those. Another danger zone area I would say is knowing that sometimes when price does get to this liquidity area right here, so I like to say this is a danger zone, because when price gets to the close of the low or high, price does react in a certain way. It doesn't have to get all the way to the bottom wick. As soon as it gets into this region right here, price does react. So sometimes you might want to leave here. These are different options that you guys can use. I'm just giving you all the different options, literally depends on which one you prefer, because supply and demand is still the same supply and demand, but you can kind of trade it in different ways that suits you. I have my own, others have their own, right? But all of these are still viable options. So that is pretty much all of the confluences. If you do have any questions, leave it in the comments below. Hopefully someone will answer, or I'll try my best to get through every single comment to help if I can. So hope you guys did find some value in the video. If you did, just leave a like. That is all I ask for. Thank you guys for watching this video, and I'll see you guys in the next one. Peace.